Today we're starting with Chapter 7. All right, accounting for receivables. We talked a little bit about receivables, the first few weeks. Today we'll talk a little more detail about them. All right, let's start out to remind you what is a receivable and how they occur and are recorded. Remember, a receivable is when you make a sale on credit or provide a service on credit. It means you did the job and you get paid later. And again, like I said, you got to keep a separate account for each customer because remember, you can have millions of customers you do credit sales or provide services for. Again, so we'll review here. Remember, account receivable is an asset. You want to increase it when you first earn it with a debit and credit sales. And of course, the next part, when you receive payment. When you receive payment, again, you want to debit cash or increase cash. And you want to credit receivables to remove the receivable, to decrease it because it's been paid, it's done. And again, if you notice right here, remember, receivables, yes, you have your master balance. Okay, you have a master balance right there. But then for each account, for each person you have receivable for, such as RDA Electronics, they had $1,000, made a payment, now they owe $280. Comstar bought $2,000, bought some more, now they owe $2,950. Again, store credit card. Again, store credit card is a little bit better for the company because, again, here, sometimes they might earn the interest. They don't have to pay any fees to Visa or MasterCard. So again, straightforward. Receivable sales, and obviously you earn some interest there too. And a bank credit card, again, it's good and bad. The good is, customers might buy more. Plus the risk, now it's on Visa or MasterCard. The downfall is you got to pay the fee there. It says $100, except, we'll just say Visa, they charge you a 4% fee. Installment. Remember, installment means, again, over time you're making sales. By credit sales, remember, a lot of times people don't buy, like say, house or cars immediately. You have to buy them over time. And again, the drawback is the customer has to pay interest on those installments. Again, an example. Sold merchandise, receipts, deposit, retails bank. Again here, just straightforward. Again, they said the customer's credit card. There's a credit card expense fee there. Now sold merchandise. Again, the customer's Visa card. And again there, had to pay that credit card expense. The $400 sale with $12 had to go to Visa. And again, there was some interest here on the store credit card. Yeah, it's receivable, and again, interest revenue. Now, the challenges with receivables, you make a lot of sales on credit for service on credit. The big challenge and the drawback is you might never get paid for it for whatever reason. As another idea was called a direct write-off method. Might not pay their account for whatever reason. You get two methods we're going to talk about here. The direct write-off method and the allowance method. The direct write-off method, like it says here, it says exactly this person, Mr. Ken here, owed us some money, didn't pay us for whatever reason. Just, again, straightforward. Goes to a new account, an expense account called bad debt expense. And you credit receivables to remove Mr. Kent's account because, well, we know we're not going to get paid for it. Now, let's say Mr. Kent comes back and says, hey, sorry about that. I'd like to do business with you again. Would you, obviously, do business with him again? You say, yeah, sure, Mr. Kent, we can do business with you again. The only drawback is we want you to first pay back the money you owed us. So the write-off, the first thing you got to do is reverse the write-off. So you want to reinstate the receivable and remove the bad debt expense. And after we do that, and just record a regular routine payment, just debit cash, and now we can remove the receivable account a little bit better now because we actually got the cash for it. It's not a write-off anymore. Now, probably the write-off method is it's not really well used because it doesn't really match sales and expenses. It violates expense recognition principle. You report that bad debt expense in the accounting period as the sales they produced. It's not going to be good here. That's why the write-off method. It's good for companies, the smaller companies. They only have a certain amount of credit customers. And the big companies, the Walmarts, the Costco's, they're not going to use the write-off method. An example of some, cannot collect it. So we talked about debit bad debt, credit receivable. And be specific. Don't just put receivable down. In this case, it's ZZ Company. When they pay back, again, reverse the write-off and just record a routine payment. Now, the most popular method, the one we're going to talk about, is going to be the allowance method. Again, at the end of each period, we have to estimate our total bad debts. How much bad debt do we think is going to be there? Again, the advantage is estimate bad debts. We're going to match up the expense in the period sales. And again, you're going to report the accounts receivable at the estimated amount we think we can collect. Again, here it says here, based on experience and everything, out of all these credit sales, we estimate about $1,500 of that is not going to be collected. So it still goes to bad debt expense, but now a new account called allowance for doubtful accounts, or ADA. as a contrasted account. That will be going against receivables. It should have a credit balance. So again, if you see on the balance sheet, again, realistically, we know we're not going to get all of our credit sales. So we're owed $20,000. We estimate about $1,500 of that not going to be paid. So we estimate the net accounts receivable, we should get about $18,500. Again, now let's say we determine exactly. We're still doing allowance method, but now we decide we found out Mr. Kent's really not going to pay us. So now we want debit allowance for doubtful accounts to lower the balance because it's no longer doubtful. We know we're not going to get paid for it. It's not doubtful now. We know exactly we're not going to get paid for it. And then you want to credit Mr. Kent's account because, well, now we can actually write it off. Because, well, we know we're not going to get it. It's not doubtful anymore. And we got to remove it because Mr. Kent's not going to pay us. And if you notice, the write-off doesn't affect the realizable value, the net AR value. Again, let's say Mr. Kent comes back again and says, hey, can we diminish this again? You tell him, listen, no problem, Mr. Kent. We can diminish this again, except that $520 you owed us, we want to pay. So similar like we did before, you want to reverse the write-off. And then again, the next part, just record a regular cash payment on account. Again here, give me some examples. Estimate $3,000 of accounts receivable is uncollectible. Again, bad debt and allowance for doubtful accounts. Now it says you cannot collect $400 of receivables from ZZ Company. And now we directly decrease allowance for doubtful accounts and credit accounts receivable is ZZ Company. Next part, you recover it. We talked about reverse the write-off we did. And this will record a routine regular payment. Now, remember, before we just, we calculate a figure here. Now it says we want exact figures. Documentation, estimate based on sales or accounts receivable. And we got two methods, percent of sales and the AR method. And percent of sales says straightforward. Just say your current period sales, multiply by a bad debt percentage. So here it says here, $400,000, 0.6% of that. So it's okay, based on past experience, what it should be about. Again, just as we did earlier. Debit bad debt expense, credit allowance for doubtful accounts. Receivable says, all right, what's our total estimated minus our previous balance, get our current bad debt. So here it says, okay, if we use the percent receivables method, $50,000 of that, we set 5%. So here it says the balance should be $2,500. Be a little bit different. Now we have $2,300 in there. So the adjustment should be for the difference here. Because we only have $200, so the adjustment should be for the difference. Because we want to make the balance go from $200 to $2,500. Okay. This one says, what should we adjust the amount by to get to this final balance? Okay, the last we talk about, we want to classify the receivables. It's called the agent receivables method. This one says, okay, break down the receivables by their due dates. Again, not yet due, we estimate about 2% of that. Now, of course, more time goes on, the percent gets higher. We start at 2% not yet due to over 90 days, that's 40%. So again, this says, okay, our allowance for doubtful accounts should be $2,270. Now, if you notice here, we had $200 in there. To get to $2,270, again, do the difference, $2,070. Now remember, the balance should always be a credit, but sometimes I might have a debit balance. So now instead of subtracting the difference, you got to add the difference to get to $2,270. So take the $500 plus the $2,270. The adjustment should be that difference, $2,770. And summary of methods here. Give an example here. And again, bad debt expense, remember, that goes on the income statement. It's an expense. Allowance for doubtful accounts, that's going to go on the balance sheet. So again, first things first, it says here, you have a debit balance, $10. Remember, we cannot be a debit balance. Now, when we do our method here, it says it should be $49. So you want to add them together. Then the straightforward, the entry, debit bad debt expense, credit allowance for doubtful accounts. Now, it's a credit balance, it should be $52. So again, now, credit the difference, bad debt expense, allowance for doubtful accounts. Again, here, debit balance. Remember, you can't have balance. Bad debt expense. Now, we talk about accounts receivable. Man, how about notes receivable? Notes receivable is when you give a loan out. A note, just like you have your home note or car note. Again, when you do buy, let's say, a house or a car and get a loan, you sign what's called a promissory note. Promissory note says exactly you have a written promise to pay back a specific set of specific figure, your principal plus interest, and you have to pay back by a certain date and time. Okay, this for example says, okay, June 10th, you promise to pay in 90 days. 90 days from the date of the note, not the date you receive it, the date of the note. So here it says, okay, if you got on July 10th, by October 8th, you have to pay back the maturity. That means the principal you received, $1,000 plus a 12% interest. Remember, interest is always based on in 1 year, even if it's a 90-day note, and you want to use 360 days. Take $1,000 times 12%. Times 9 divided by 360. So on this $1,000 loan, you got to pay an extra $30 of interest. And you got to pay it all back in 90 days. How do you record a note here? Again, the note now says, okay, you made a sale with the notes. Again, you want to increase your receivable, your asset, credit sales. The honor and dishonor of a note. So now it says, okay, you get the cash back, plus, you get the notes receivable, plus you receive $15 of interest. Now remember, that's your revenue. That's how banks and a lot of companies make money. Dishonor note, now it says, well, it's no longer notes receivable, we're going to make it accounts receivable. And again here, now, you still, even though you didn't receive the interest, you still earned the interest. And now you expect to receive this money from Jay Cook. Again, now, what happens if the notes, it ends December, but you don't get paid until January? That's fine. You want to accrue how much interest has accrued so far, from December 16th to December 31. So that'd be an extra $15 you earned, but not yet received. That's why you want to debit the receivable, credit the revenue. And again, the next part, you record everything, all the payment you received. The revenue you earned the next period, the receivable, plus the note, that's all cash you received. Here's some examples. Again, when you first give a note out, you accrue some interest. Now you get fully payment. Again, convert cash for maturity. Again, sometimes some companies, what they might do is sell the receivables, collection companies, or pledge some receivables to purchase something. Okay. All right, class. Let me know if anyone has any questions, all right? Thank you. Bye.